What's up, it's your boy Saliq, here with Pearson Smith Realty. Today I'm with Lindsay Marsengill, one of my favorite people. Not only that, my lender partner for the past 8 years. Today we want to talk about ARMs. I know it had a negative connotation back in the day, but things are changing, the market is changing, and that's why we're here. So Lindsay, tell us about ARMs.
You're not wrong. They definitely had a negative connotation back in the day, but they have definitely made a comeback. Over the last few years, I think it's safe to say that the market has been absolutely insane.
Right, it has.
I think it has officially slowed down, which is great, at least for our buyers. They're no longer offering
100K over asking.
Yeah, 100K over asking. They're finally being able to keep most of their contingencies in place. They're financing their appraisal, home inspection. What else? Anything else I'm forgetting?
Nope. You kind of got it covered.
They're finally being protected by their contracts, which are fantastic news for them. The only thing that we're a little hesitant about is interest rates. They have started to rise, but that's fine. With that being said, most mortgage companies are having to be more creative with their financing options. 15-year fixes, 30-year fixes, right now they're a thing of the past. We have ARMs making a huge comeback. If I had to say, at least in the last 6 months, I've probably only done 1 or 2 30-year fixed loans. Right now it's all about those ARMs, so the lower interest rates, the better.
And why is that?
So we have so many ARMs available. We have 5, 7, 10, 1 ARMs. We have 5, 7, 10, 5 ARMs, 5, 7, 10, 6 ARMs. I mean, but what does that really mean for you guys?
What are ARMs?
Great question. So we're going to talk about the 7, 1 ARM today. Interest rates, assuming a $900,000 purchase price with 20% down, you're looking at a 30-year fixed rate of 5.125%. With the 7, 1 ARM, you have an interest rate of 4.49%.
And how much does that save them monthly on a $900,000?
Let's just say $276 a month, to be exact.
Awesome.
That is $23,184,000 just in monthly savings over that first 7 years. But if you include the interest savings, you're saving $31,572 in compounded interest savings. That's huge.
That's amazing. And that's based on a $900,000 purchase price.
With 20% down.
So a single family in Northern Virginia.
Correct. Absolutely. Now, if you don't really care about this monthly savings, the $900,000 purchase price with 20% down, that's a $720,000 loan amount. The 30-year fixed rate is 5.125%. That is a monthly principal and interest payment of $3,920. If that sounds great to you, but maybe you're looking for a bigger house, with the 7-1 ARM keeping that same principal and interest payment of $3,900, you can afford a $775,000 loan amount or a $970,000 purchase price.
So you could still offer
That's
better, really.
Correct. Or buy a $70,000 more expensive home.
For sure.
With hopefully bigger.
So things are not the same. So they're not going over 100% at $100,000 asking price. They're typically going, at asking or even less at this point because we don't know what the market is doing.
Right. 100%.
So cool. You can purchase more using a 7-1 ARM.
Correct.
Versus a normal 30-year mortgage. So tell us a little bit more about what does that really mean, 7-1?
Sure. So the rate climate right now is only a moment in time. The Fed is trying to fight inflation with whatever tools that they have, and one of those tools is increasing interest rates. With that being said, once inflation becomes under control, the interest rates are going to decrease. Once they decrease, you have the opportunity to refinance, either out of your really high interest rate on that 30-year fix or from your ARM to a lower interest rate on a 30-year fix before your adjustment on that ARM even takes place.
So can you break down what 7-1 actually means?
Yeah. So the 7-1 ARM is a 30-year long loan. It is fixed for that first 7 years, so the 7 and the 7-1 ARM. Your interest rate of 4.49 in this scenario is fixed for 7 years.
Understood.
Every year after that, every year after that, the interest rate can adjust.
And what would it adjust to?
So people are always terrified that rates are just going to absolutely skyrocket. The good news is there are limits on how much the rate can adjust on these ARMs. For this specific scenario with that 7-1 ARM, we have something called 525 caps, meaning that first rate adjustment on year 8, the interest rate cannot increase by more than 5%. Every year after that, the interest rate cannot increase or decrease by more than 2%, but over the life of the loan, the rate cannot increase by more than 5% total.
Okay. When you talk about, your rates changing after the 7 years, how much can they actually adjust? Because 5%, if I'm at 4.49 right now, 5% increase
by 5.
It's kind of crazy, right?
Yeah.
So you're looking at 9%. So how much do the rates actually adjust?
Great question. Your rate on this 7-1 ARM adjusts by adding your margin to your index. But what the heck is a margin and what the heck is an index?
Tell me more.
So the margin on this specific loan is fixed at 2.5%. The index is based off the 1-year treasury rate. Over the last 5 years, the average 1-year treasury rate was 1.4%. So if you are on year 8, your first adjustment, and your 1-year treasury rate is 1.4%, you take 1.4, 2.5, which is the fixed margin for this loan, you add them together and you have 3.9. Technically, that would be your new rate, but your interest rate can never drop below your base rate of 4.49. So your interest rate would just stay the same.
That makes perfect sense. And as you know, I recently purchased a property and I'm using a 7-1 ARM program as well. Yes, I'm locked in for the next 7 years, and if the rates go down, we could refinance. So tell me more, a little bit more. I know that that's not the only program that you guys have.
In regards to ARMs?
Yes.
So we have, like I said at the beginning, we have the 5-year, we have the 7 that we just talked about, and we have the 10. The 5-year would have a term that is only fixed for 5 years, for the first 5 years of the loan. The 10 is fixed for 10 years of the loan, which is more than 7, so people are a little bit more
comfortable.
Yeah, exactly, comfortable. Now, as you go lower in fixed terms, your interest rate also goes lower. As you go higher, the interest rate is going to be slightly higher. So the 5-year is going to have a lower interest rate than the 7, and the 7-year is going to have a lower interest rate than the 10.
Awesome. And that's good information, especially if it's your first time buying a home. Average person stays in their home 5 to 7 years. And most likely you're going to be selling in the next 5 to 7 years. So this could be a great way of getting in, not pay the 5% that's currently going on, and still being able to afford a lower interest rate that everybody's looking for.
Yeah, 100%.
Cool. So thank you so much for your information. Again, guys, I know that it's scary that interest rates are going high, but there are other programs out there. However, not everybody's doing them. So Intercoastal Mortgage and Lindsay is my girl to reach out to, especially if you're looking into ARMs. If you need more information, hit your boy up, Saliq with Pearson Smith Realty, or my girl Lindsay with Intercoastal Mortgage, and see you in the next video.